Today starts a very busy week of earnings. To discuss all of it, let's bring in a man who has a lot of skin in the game. Tim Lesko, principal at Granite Investment Advisors, owns a big chunk of companies that are due to report earnings this week, including Boeing, Facebook, Alphabet, and Amazon. Tim, good to see you. So I guess how high are the stakes right here for some of these names that you own? On one level, you know, the beat rate is high. 75% of companies already beating published estimates. But the market seems to be much more focused on what comes next, not what happened last quarter.
Well, certainly it's always high stakes during earnings season, and particularly what you might call earnings week with such a large chunk of the S&P 500 reporting. It would be hard to have a portfolio and not have a significant number of names reporting this week. The stakes certainly have been higher after Fed rate cut talk and how everybody expects the market to accelerate in the second half of the year. So it's pretty important. But really, at the end of the day, earnings are what matter, so that's why we pay attention during weeks like this.
Earnings going to matter a lot for Boeing, for example, this quarter, or what's going to be the next thing that drives the story there?
Well, I think Boeing's announcement at the end of last week about taking a charge based on the 737, call it reparations to airlines, changes the story a bit. I don't think people are going to be looking at this quarter's earnings, but hopefully get some guidance as to what earnings look like in the future and when, if any guidance they can give us on when they're going to begin selling the 737s again. And that represents a pretty good chunk of earnings. So I don't think anybody expects a whole lot this week from Boeing.
And just quickly, do you think the stock actually kind of incorporates this moderated view of what the 737 can deliver in the short term?
Well, I think the stock has really been confusing people because it's still up on the year. It's up actually in the mid-teens year to date for a company that's had such headline risk and headline problems. What it really shows is the broader strength of Boeing's product line, and including the defense side of Boeing. So I think sure.
Tim, I was going to get to Alphabet just because didn't have a great quarter or response to that quarter last time around. What are you expecting out of the company this time? And again, what is the stock price in right now?
I think what we're really looking for out of Alphabet is a continued, call it mid-20s growth in the advertising business. At the end of the day, really what drives this company is advertising sales, and the consumer side of the economy remains strong. And if they're continuing to gain share in that business, then everything's going to be okay at Alphabet.
Everything's going to be okay at Facebook, too?
Well, another company that is clearly suffering from headline risk. Their move into digital currencies has put them in front of Congress again. Never like to see your companies in front of Congress. However, they still are part of a huge secular tailwind of advertising moving online. And if you're faced with a decision as to where to advertise right now, you really only have 3 or 4 choices as to where you're going to put those ads. And Facebook is easily in the top 2 of that list.
Overall, Tim, we were just talking earlier about how much of this market move this year has been accruing to the very big growth stocks out there. Does that make sense to you at this stage, given what else is going on in terms of broad global growth, or is the market overplaying its hand in some of these stocks?
Well, I think the market is really putting a premium on those who are able to grow earnings. In an uncertain time, those companies that continue to show growth seem to be getting most of the lion's share of investor dollars. And when you have the Federal Reserve expected to lower interest rates in an otherwise growing economy, it means that other sectors may be suffering. So it's really been affecting the industrials and those areas that we trade internationally with, where these domestic growth companies seem to be somewhat immune to that.
Well, if in fact the Fed is going to cut and you have a lot of these cyclical stocks that were beaten up on a relative basis, would that not be the area that might take up the lead?
Well, certainly. Certainly the valuations are very compelling. You have defense stocks, you have industrial stocks that are trading at mid-teens multiples in a market that's in the high teens, and some of these technology stocks in the mid-20s, if not in the mid-40s. So the valuations are very compelling in industrials. It's just very hard for investors to get a sense for what those earnings are going to look like 6, 8, 12 months down the road. And people worry that those valuations may even be high if earnings don't come in.